Resource nationalism, the trend of host governments increasing control and ownership over natural resources within their borders, is on the rise in the mining industry. This phenomenon has significant effects on mining operations, particularly in countries that produce rare metals and minerals crucial to the global energy transition. The recent surge in resource nationalism is making waves in the global mining sector, with several countries laying claim to their natural resources in a bid to gain greater control, maximize profits, and fuel national development. Resource nationalism refers to actions taken by governments to control, regulate, and often take a larger share of revenue from their country's natural resources. This can range from increased taxes and royalties on mining operations to full-scale nationalization of assets. The motivation behind such moves can be economic, political, or both. The concentration of production and reserves, strategic importance of the sector, and potential for high prices create fertile ground for resource nationalism. Host states employ various measures to increase control, capture a larger share of proceeds, and acquire higher ownership in projects at the expense of foreign participation. This can have profound effects on mining operations. Increased regulatory and tax burden. Host governments may toughen tax and regulatory rules governing foreign-owned resource projects. This can lead to higher costs and reduced profitability for mining companies. Governments worldwide have always grappled with the challenge of balancing the economic benefits that come from mining operations with ensuring that a fair share of profits remains within the country. One way to achieve this balance is by tightening regulations and increasing taxes on these operations, especially when they are foreign-owned. Immediate financial impacts. Higher operating costs. New regulatory measures might necessitate additional compliance actions, such as regular environmental impact assessments, stricter waste management protocols, or enhanced safety measures. While these can be beneficial for the environment and workers, they also drive up costs. Reduced profit margins. Higher taxes directly eat into the profits of mining companies. This can be especially challenging for operations where margins are already thin due to lower commodity prices or high extraction costs. Impact on investment and expansion. Investor deterrence. A suddenly increased tax or changing regulatory landscape can deter potential investors who might see the operation as less lucrative or more risky. Hesitation in expansion. Companies might be hesitant to expand their operations or invest in new technologies in regions where the tax and regulatory future seems uncertain. Long-term strategic revisions. Rethinking geographical presence. Mining companies may prioritize operations in countries with more favorable tax and regulatory environments, potentially pulling out of regions where they see an unsustainable future. Shift to automation. To offset increased costs, companies might fast-track automation, which could lead to job losses in the short term. Implications for the host country. Short-term revenue boost. Increased taxes can lead to a surge in revenue for the host country, which, if used wisely, can fund public services or infrastructure projects. Potential long-term revenue loss. If mining companies scale back operations or exit the country entirely due to the heightened tax and regulatory environment, it could result in reduced revenues in the long term. Job implications. Regulatory burdens can have mixed effects on employment. While stricter safety and environmental regulations might create jobs in compliance and monitoring, they can also lead to job losses if companies scale back operations or accelerate automation. Global supply chain implications. Price volatility. A reduced supply from one region due to regulatory and tax challenges can lead to increased commodity prices, affecting industries and consumers worldwide. Relocation of operations. The global nature of the mining industry means companies can relocate to more favorable jurisdictions, leading to a shift in the global supply chain dynamics. While the intentions behind increasing the regulatory and tax burdens on mining operations are often to ensure that the nation benefits more substantially from its natural resources, the implications are multifaceted. Both governments and companies need to navigate this landscape carefully to ensure a sustainable and beneficial coexistence. Strained investor relations. The unpredictability that accompanies resource nationalism has led to tensions between governments and international investors. A country's sudden shift in its policies can render previous contracts and agreements void, undermining trust and deterring future investment. Resource nationalism's unpredictable nature poses a substantial challenge to international investors. While governments have a legitimate interest in ensuring that their citizens benefit from their country's resources, abrupt shifts in policy can have far-reaching implications. One of the most significant consequences is the strain on investor relations, a delicate balance between profit, trust, and national interests. The fragility of contracts and agreements. Unpredictable policy shifts. Governments may, for various reasons, economic, political, or social, decide to modify or revoke existing contracts. Such actions can be perceived as capricious, leading to investor skepticism. Retroactive application. In some instances, new regulations or tax regimes are applied retroactively, meaning they affect existing contracts. This can be particularly concerning for investors who made decisions based on the old rules. The domino effect on investor confidence. Erosion of trust. When contracts are altered or nullified, it signals to investors that the government might not honor future agreements. This erodes the foundational trust that underpins long-term investments. Risk perception. Such unpredictability heightens the perceived risk associated with investments. When risk increases, it can lead to higher demands for returns, more stringent contract terms, or a complete withdrawal of investment. Economic implications. Capital flight. A strained relationship can lead to investors pulling out their capital, either to cut losses or avoid further unpredictability. This can have detrimental effects on the country's foreign exchange reserves and financial stability. Increased borrowing costs. As the country becomes perceived as a higher risk environment for investments, it might face higher interest rates when it tries to borrow money on the international market. Broader geopolitical impacts. Shift in investment landscape. Investors might prioritize other countries with more stable policy environments. This can lead to a shift in global investment flows, with some countries benefiting at the expense of others. Diplomatic tensions. Large-scale investments often come with diplomatic strings attached. A strained investor relation can escalate into broader diplomatic tensions between the host country and the investor's home country, especially if significant sums or strategic interests are at play. The ripple effect on local communities. Job losses. If foreign investors withdraw or reduce their operations, local communities might face job losses, leading to economic and social hardships. Reduced local investments. Many international investments come with commitments to invest in local communities, be it in infrastructure, education, or health. A pullback can deprive communities of these benefits. Potential legal ramifications. International arbitration. Many investment contracts have clauses that allow for international arbitration in case of disputes. Governments that alter or nullify contracts might find themselves in lengthy and expensive legal battles. While resource nationalism's motivations are often rooted in valid national concerns, the means and abruptness of its implementation can have profound impacts. Strained investor relations is but one dimension, albeit a critical one, that underscores the intricate interplay of national interests with global economic dynamics. Renegotiation of contracts. Governments may seek to renegotiate contracts with mining companies to secure more favorable terms. This can create uncertainty and disrupt operations. The renegotiation of contracts, particularly in the mining sector, can be a highly contentious issue. When governments move to revisit existing agreements with mining companies, it's often to ensure a more equitable distribution of revenues, align with new national objectives, or respond to public pressure. Reasons for renegotiation. Economic shifts. If global commodity prices soar, governments might feel that the earlier terms no longer reflect the resource's true value and seek a greater share of the profits. Political changes. A change in leadership or government might bring in new ideologies or policies focused on resource nationalism or economic redistribution. Public pressure. Growing awareness among the populace about resource wealth and its distribution can compel governments to revisit contracts, especially if they perceive previous deals as unfavorable. Operational disruptions. Uncertainty. The period during which contracts are being renegotiated can be filled with uncertainties. Companies may be unsure of future tax rates, royalty payments, and operational guidelines. Operational halt. In some cases, operations might be halted temporarily until new terms are agreed upon, impacting production and revenues. Cost implications. The need for legal consultations, impact assessments, and potential alterations to operations based on new terms can introduce additional costs for mining companies. Impacts on investment. Deterrence to new investors. Watching a government renegotiate contracts can deter potential investors who might perceive the environment as unstable or unpredictable. Reassessment of existing investments. companies may re-evaluate their ongoing projects and investments in light of the new terms, potentially scaling back or withdrawing entirely. Strategic implications for mining companies. Diversification. To minimize risks, mining companies might diversify their operations across several countries, ensuring they aren't overly reliant on a single nation with fluctuating policies. Enhanced due diligence. Companies may become more thorough in their due diligence before entering agreements, ensuring they can adapt to potential future changes without significant disruptions. Impacts on the host country. Short-term financial gains. Successful renegotiation from the government's perspective might lead to increased revenues in the short term. Potential economic setbacks. If companies pull back or cease operations, it can lead to job losses, reduced foreign direct investment, and broader economic repercussions. Reputation risks. Continual renegotiation or perceived unfair treatment of companies can tarnish a country's reputation as a stable investment destination. Broader stakeholder impacts. Local communities. While renegotiations can potentially lead to better terms for the country, local communities might face immediate disruptions, particularly if operations are halted or scaled back. Shareholders of mining companies. Shareholders might see a decline in returns due to operational disruptions or less favorable terms, leading to potential declines in stock prices. While renegotiation of mining contracts can be a tool for governments to ensure fairer terms and alignment with national objectives, the process is fraught with challenges and potential pitfalls. Both governments and mining companies need to navigate this space with a clear understanding of the implications and a focus on long-term sustainability and mutual benefit. Operational uncertainties. With increased risks of expropriation or higher taxation, mining companies might slow down or halt expansion projects. They may also re-evaluate their presence in certain countries, impacting jobs and local economies. The mining sector, with its substantial capital investments and extended project lifetimes, requires stability and predictability. Operational uncertainties, such as the threat of expropriation or increased taxation, can drastically affect a company's strategic decisions and, subsequently, the host country's economic landscape. The nature of operational uncertainties. Expropriation risks. This refers to the risk that a government will take ownership of a company's assets without adequate compensation. It's the most extreme form of resource nationalism. Taxation concerns. While governments have every right to tax companies operating within their borders, sudden hikes or unpredictable tax regimes can be detrimental to long-term projects, making them unviable or less profitable. Effects on company strategy. Hesitation in expansion. If there's uncertainty regarding a country's regulatory framework or fear of expropriation, companies might be hesitant to invest in expansion projects, even if initial exploration data is promising. Re-evaluation of current operations. Companies might review their existing operations to assess if they remain viable under potential new conditions. This can lead to scale downs or complete cessation of operations. Resource allocation. Firms may opt to divert funds to projects in more stable jurisdictions, leaving uncertain regions starved of potential investment. Impact on employment. Job reduction. Hesitation in expansion or reduction in current operations directly affects employment. Mining projects, especially in the exploration and development phases, can be significant job creators. Loss of skilled workers. If companies slow down or halt projects, skilled workers might seek opportunities elsewhere, leading to a brain drain from the affected region. Economic repercussions for the host country. Reduced foreign direct investment, FDI. Mining is often a considerable source of FDI for resource-rich countries. Operational uncertainties can deter not only the affected company but also other potential investors who observe the situation. Drop in revenue. Governments might face a decline in expected revenues, both from reduced operations and potential declines in new investments. Local economies. Mining operations often spur local economies, driving growth in ancillary sectors like transportation, housing, and services. A scale down can ripple through these sectors, causing broader economic slowdowns. Social and community impacts. Community development. Many mining projects come with community development commitments, such as building schools, health centers, or infrastructure. Uncertainties can halt these initiatives, depriving communities of anticipated benefits. Social unrest. If large numbers of people are laid off or if communities feel they're being deprived of their share of resource wealth, it can lead to protests, strikes, or even conflicts. Broader industry implications. Supply chain disruptions. A slowdown or halt in operations can disrupt global supply chains, especially if the mined resource is rare or vital for specific industries. Price volatility. Reduction in supply can lead to commodity price fluctuations, impacting global markets and industries dependent on the resource. Governments have valid reasons to assert control over their resources. The introduction of operational uncertainties can have multifaceted implications. These can span from immediate job losses to long-term shifts in global commodity markets. A collaborative approach between governments and companies, prioritizing clear communication and long-term sustainability, is crucial to navigate this delicate balance. Nationalization of assets. Nationalization of assets is an extreme measure that governments may take to increase their control over mining operations. This measure involves the seizure of mining assets by the government, which can result in the complete loss of investment for foreign companies. Nationalization, or the act of a government taking control of private assets, is not a new phenomenon, especially in the mining sector. Nationalization of assets is a rare occurrence, but it can create uncertainty and disrupt operations, leading to reduced profitability and investment security for mining companies. In 2022, Mexico nationalized its lithium mining industry, which involved amending articles of Mexico's mining law to promote an economic orientation in favor of large mining companies, both national and transnational corporations, to the detriment of the fundamental rights of Mexicans. Causes of nationalization. Economic motivations. Governments may believe that they can garner more revenue by directly controlling and operating mining assets, rather than just taxing or receiving royalties from foreign operators. Political considerations. National leaders might aim to bolster domestic support by asserting control over valuable resources, projecting an image of autonomy and resistance to foreign influence. Public opinion. If local populations believe they're not getting their fair share of the benefits from mining activities, or if environmental concerns are paramount, there can be substantial public pressure on governments to intervene. Legal or contractual disputes. Alleged breaches of contract, environmental regulations, or labor laws by the mining company can give governments a pretext to seize assets. Immediate impacts on foreign investors. Loss of investment. Foreign firms can face the complete or partial loss of their capital investment, which, in the mining sector, can amount to billions. Stock value decline. News of nationalization can lead to a sharp decline in the stock value of the affected company, impacting shareholders worldwide. Operational disruptions. Even if nationalization is temporary or pending a legal challenge, operations might be halted, causing significant production and revenue losses. Long-term implications for the host country. Investor sentiment. Nationalizing assets can drastically tarnish a country's reputation as a safe and stable investment destination. This may deter not just mining companies but investors in other sectors as well. Operational efficacy. Governments may not always have the expertise or resources to operate seized mines effectively, leading to reduced production, inefficiencies, or environmental mishandling. Diplomatic tensions. Asset seizure can cause significant diplomatic strain between the host country and the home country of the affected company. Legal recourse and international arbitration. Bilateral investment treaties, BITs. Many countries have BITs in place that protect foreign investments. These treaties can be invoked to seek redress, often leading to international arbitration. Compensation claims. Companies can claim compensation for their losses, and while international courts might rule in their favor, enforcing such rulings can be challenging. Historical case. Kyrgyzstan and the Canadian firm. The Kyrgyzstan gold mine incident is emblematic of the risks associated with international mining ventures. The Canadian company Centerra Gold faced long-standing disputes with the Kyrgyz government over profit-sharing and environmental issues at the Kumtor gold mine, one of the country's biggest assets. Tensions culminated in 2021 when Kyrgyz authorities took control of the mine, citing environmental concerns and alleged financial misdemeanors. This action resulted in significant financial losses for the company and raised questions about Kyrgyzstan's investment climate. The case served as a stark reminder of the geopolitical risks associated with mining in regions with volatile political landscapes. Nationalization can serve national interests or respond to domestic pressures. It invariably introduces a myriad of complications both for the host country and affected companies. Balancing national aspirations with the need for foreign investment and expertise is a delicate act that requires foresight, clear communication, and mutual respect. Slowdown in low-carbon technologies. Resource nationalism in countries producing rare metals and minerals crucial to low-carbon technologies can slow down the adoption and spread of these technologies. This is because increased control by host governments may limit access to these resources. As the global community seeks to transition to more sustainable energy sources, low-carbon technologies have emerged as the bedrock of the future energy landscape. These technologies, ranging from electric vehicle batteries to wind turbines, rely heavily on specific rare metals and minerals. When resource nationalism plays a role in countries producing these critical resources, it can inadvertently act as a speed bump in the world's quest for greener energy. Here's an in-depth exploration of this phenomenon. The centrality of rare metals and minerals. Vital role in green tech. Rare metals like lithium, cobalt, and rare earth elements, REEs, are foundational for various green technologies. For instance, lithium and cobalt are crucial for electric vehicle batteries, while REEs are essential for permanent magnets in wind turbines. Limited producers. These rare metals and minerals are not evenly distributed globally. A handful of countries dominate the production landscape, making them critical links in the global supply chain. Impacts of resource nationalism on low-carbon technologies. Restricted access. Governments might limit the export of these critical minerals and metals, either to nurture domestic industries or as a geopolitical tool. This can strain global supply chains and make it harder for manufacturers to source the required materials. Increased costs. Nationalistic policies, such as higher taxes or export duties on these resources, can drive up costs. This can make green technologies more expensive, potentially slowing adoption rates, especially in cost-sensitive markets. Investment hesitation. If a country known for its mineral wealth becomes unpredictable due to resource nationalism, it might deter foreign investments in exploration and mining. Over time, this can lead to supply constraints. Broader implications for the green transition. Stalling momentum. Any slowdown in the production or rollout of green technologies can hamper global efforts to reduce carbon footprints and combat climate change. This is particularly critical as many countries aim for aggressive carbon neutrality targets. Reliance on traditional energy sources. If low-carbon technologies become costlier or less accessible, it may prolong the global reliance on traditional fossil fuels, thus exacerbating environmental concerns. Innovation drive. On the positive side, supply constraints could drive innovation. Manufacturers and researchers might seek alternative materials or more efficient designs to bypass or mitigate the impact of limited access to these metals and minerals. Potential mitigations and strategies. Diversifying supply chains. Relying on a diverse set of suppliers can insulate industries from the effects of resource nationalism in any single country. Recycling and repurposing. As more of these technologies reach the end of their life cycle, strategies focusing on recycling and repurposing materials can reduce the demand for new raw materials. International collaboration. Bilateral and multilateral agreements can help stabilize supply chains, ensuring that geopolitical factors do not overly influence the green technology landscape. The transition to low-carbon technologies is a global imperative. The pathway is fraught with challenges. Resource nationalism, and its potential to disrupt access to essential metals and minerals, underscores the complex interplay of geopolitics and sustainability. As the world marches towards a greener future, understanding and navigating these complexities will be paramount. Higher costs and reduced profits. Resource nationalism can lead to higher costs for mining companies due to increased taxes, regulatory burdens, and renegotiated contracts. This can reduce profitability and make it harder for companies to replicate the bumper profits of previous commodity supercycles. The realm of mining is inherently complex, woven together by geological, technological, financial, and political threads. When resource nationalism enters this tapestry, it often tightens the financial constraints on mining entities. Here's a breakdown of how this political inclination can lead to higher costs and reduced profits for mining companies. Understanding resource nationalism. Defining the term. Resource nationalism refers to policies or actions taken by governments to exert greater control over their nation's resources. While it stems from the noble intent of benefiting the local population, it can have pronounced implications for foreign and private investors. Taxation increase. Higher levies. Governments, aiming to capture a larger share of profits from resource extraction, may hike taxes, royalties, or introduce windfall taxes. While this increases state revenue, it invariably shrinks the profit margin for mining companies. Retroactive taxes. In some instances, governments have even introduced retroactive tax regimes, demanding companies pay for perceived past dues. Amplified regulatory burdens. Tougher regulations. Regulatory frameworks may be tightened, demanding higher environmental, safety, or social standards. While such standards are crucial, sudden or stringent shifts can escalate operational costs. Licensing and permitting. Governments may make the process of acquiring or renewing licenses more demanding or expensive. Delays in licensing can also mean extended periods without operational returns. Renegotiation of contracts. Shifting goalposts. If contracts are renegotiated to be more favorable for the host nation, it can mean less favorable conditions for mining companies. Such renegotiations might entail higher state equity participation, increased royalties, or more obligations related to local content. Uncertainty and unpredictability. Constantly changing terms can deter long-term strategic planning, forcing companies to operate with shorter horizons. This can make large-scale investments, which require stable conditions over extended periods, less appealing. The impact on profits and investment attraction. Reduced profitability. The combined weight of higher taxes, stiffer regulations, and contract adjustments can severely compress profit margins, making operations less economically viable. Difficulty in attracting investment. As profitability dwindles or becomes unpredictable, it becomes challenging to attract fresh investments. Investors gravitate toward stability, and resource nationalism can send opposing signals. Comparative with past supercycles. The windfalls that companies experienced in previous commodity supercycles, periods when commodity prices were exceptionally high, become challenging to replicate. These supercycles often saw mining entities reaping massive profits due to soaring demand and prices. However, in the face of resource nationalism, even if another supercycle emerges, the elevated costs might mean that profits won't reach past peaks. The broader implications. Potential for divestment. If operating in a particular country becomes too costly or unpredictable, companies might divest their interests, impacting the host country's employment and revenue. Shift in global dynamics. Over time, mining investments could shift to countries perceived as having more stable and friendly regimes, altering the global landscape of mineral and metal production. Resource nationalism seeks to ensure that a nation's populace benefits adequately from their resources. It walks a tightrope. Balancing national interests with the practical realities of the mining sector and global investment climates is crucial to ensure mutual benefits and sustainable growth. Shift in global supply chains. As some countries become less hospitable to mining due to their nationalistic policies, supply chains can become strained. This can result in volatility in commodity prices and hinder global economic growth. The globalization of the modern world has led to intricate and interwoven supply chains, allowing resources mined in one corner of the world to be processed and consumed in another. As countries adopt nationalistic policies, particularly concerning their resources, these global supply chains can experience disruptions, with ramifications that ripple across the global economic ecosystem. Let's dive deep into how these shifts in supply chains can trigger volatility in commodity markets and impact global growth. Immediate disruptions in supply chains. Limited exports. Resource nationalism can lead to countries limiting or restricting the export of vital minerals and resources. This can result in an immediate shortage in global markets, leading to supply constraints. Change in supplier dynamics. Companies may seek alternate suppliers if a major producing country becomes too unpredictable or restrictive. This can lead to shifts in global trading routes and relationships. Volatility in commodity prices. Supply-demand imbalance. Reduced exports from nationalistic policies can create a mismatch between supply and demand. In markets operating on slim margins or where stockpiles aren't extensive, even minor disruptions can lead to significant price hikes. Speculation and market psychology. Markets aren't just driven by raw data. The perception of instability, possible future restrictions, or geopolitical tensions can lead to speculative trading, exacerbating price volatility. Impact on manufacturing and secondary industries. Increased costs. For industries reliant on these commodities, supply chain disruptions and price volatility can lead to increased raw material costs. This can compress profit margins and lead to higher prices for end products. Production halts. In extreme cases, if a particular resource is pivotal and irreplaceable, industries might face temporary production halts due to non-availability. Ramifications for global economic growth. Increased uncertainty. Volatility in commodity markets can introduce a degree of unpredictability in the global economy. Investments, especially long-term ones, thrive on stability. If key commodities become unpredictable, it can deter investments across various sectors. Ripple effects on linked sectors. Modern economies are interlinked. A slowdown or increased costs in one sector can have cascading effects. For instance, if electric vehicle (EV) battery production slows down due to lithium shortages, it doesn't just impact the EV industry but also transportation, energy, and associated sectors. Impact on trade relationships. Countries that rely heavily on imports from nations adopting resource nationalism might seek alternatives, leading to shifts in trade dynamics. Over time, this can redefine trade partnerships and alliances. Global GDP impact. The cumulative effects of supply chain disruptions, increased manufacturing costs, and reduced investments can dent the global GDP growth rate, especially if the commodities in question form a significant part of global trade. Potential mitigation strategies. Strategic stockpiling. Countries might consider stockpiling critical resources to buffer against supply disruptions. Diversification. Relying on a diverse set of suppliers can help in insulating against disruptions from any single source. Domestic resource exploration. Nations might invest in exploring and developing their own resource reserves, reducing dependence on imports. Resource nationalism emerges from the intent of safeguarding national interests. Its unintended consequences can reverberate across the global economic landscape. Recognizing these potential disruptions and preparing for them is essential for nations and industries alike to ensure sustained growth and stability. Environment and safety concerns. Some critics argue that resource nationalism can lead to lax safety and environmental regulations, as nationalized operations may prioritize profits over best practices. This could result in increased environmental degradation and risks for workers. Resource nationalism, while rooted in the principle of ensuring a nation's resource wealth benefits its citizens, sometimes has unintended consequences. One significant area of concern is the potential degradation of environmental and safety standards in mining operations. Let's delve deeper into the implications of resource nationalism on these fronts. Shifting priorities post-nationalization. Profit over protection. After nationalization, there might be intense pressure on state-run entities to deliver profits to bolster the national economy. This can sometimes shift the focus away from stringent safety and environmental standards. Reduced accountability. Nationalized operations, particularly in countries with limited checks and balances, may experience reduced external scrutiny. This can embolden lax practices as consequences for non-compliance may be diminished. Environmental implications. Degraded practices. Nationalized mining operations, under pressure to maximize output and profits, might opt for methods that are more detrimental to the environment, such as employing aggressive extraction techniques. Waste management. Proper disposal or treatment of mining waste can be a costly endeavor. Nationalized mines, in a bid to cut costs, may neglect best practices in waste management, leading to contamination of local ecosystems. Water pollution. Mining can contaminate water sources if not properly managed. With reduced oversight or motivation to maintain standards, nationalized operations might contribute to water pollution, impacting local communities and wildlife. Deforestation. The expansion of mining activities without proper environmental assessments can lead to deforestation, which has cascading effects on biodiversity and climate change. Safety concerns for workers. Cutting corners. In the rush to amplify production and profits, safety protocols might be compromised, putting workers at risk. Insufficient training. Proper training is pivotal in ensuring worker safety. Nationalized operations, especially if they rapidly scale, might not invest adequately in training their workforce, leading to increased accidents. Lack of safety equipment. Cost-saving measures might also manifest in reduced provision of safety equipment and gear, exposing workers to hazards. Broader social implications. Health risks to local communities. Environmental degradation isn't just an ecological concern. Contaminated water sources, polluted air, and degraded land can pose health risks to nearby communities. Societal unrest. Continued neglect of environmental and safety concerns can lead to tensions between the mining operations and local communities, leading to protests, strikes, or even violent confrontations. Reputational risks and global standing. International scrutiny. Countries that neglect environmental and safety standards may face international backlash, potentially affecting trade relations and foreign investments. Impact on global agreements. Many countries are signatories to global environmental agreements. Lax environmental standards can put these nations in violation of such accords, leading to sanctions or other penalties. Counterarguments and mitigations. Raising standards. Some proponents of resource nationalism argue that nationalization can lead to better standards. They posit that a nation-focused approach might prioritize the well-being of its citizens over pure profit. Strengthening regulations. Governments can preemptively address concerns by strengthening and enforcing environmental and safety regulations, ensuring that nationalized operations adhere to the highest standards. In essence, while resource nationalism's impact on environmental and safety standards varies by nation and context, the potential risks are undeniable. For countries considering or practicing resource nationalism, striking a balance between economic gains and safeguarding the environment and worker safety is crucial to ensure sustainable and holistic benefits. Countries such as Indonesia, Tanzania, and Zambia have made headlines in recent years due to their resource nationalistic tendencies. Indonesia tightened control over its vast mineral reserves by banning the export of raw mineral ores in 2014. While the move was aimed at bolstering domestic smelting industries, it initially impacted global nickel and bauxite markets. Tanzania overhauled its mining regulations in 2017, demanding higher royalties, enforcing strict export controls, and mandating that the government receive stakes in mining operations. Zambia, Africa's second-largest copper producer, has been in a long-standing dispute with mining companies over royalty rates. The government's attempt to impose competition and leverage for metal-rich countries. High global demand for metals like nickel, cobalt, and lithium, coupled with resource nationalism, can give metal-rich low-income countries further leverage in negotiations and competition with other countries, particularly China. Mining companies and investors need to take resource nationalism seriously and consider environmental, social, and governance (ESG) factors in their operations. Incorporating ESG best practices can improve business performance and help navigate the challenges posed by resource nationalism. While resource nationalism empowers nations to take control of their assets, the potential adverse effects on the global economy and the local environment cannot be ignored. It remains a tightrope walk between national interest and global collaboration. Experts opine that for resource nationalism to be beneficial, it must be implemented with a clear vision, taking into account the long-term implications for both the nation and the global community. Overall, risks and challenges are mining operations, impacting profitability, investment security, and the development of low-carbon technologies. Mining companies and governments must find ways to navigate these challenges and strike a balance between national interests and foreign investment to ensure sustainable and mutually beneficial outcomes. Mining companies are acutely aware of the myriad of risks they face, with nationalization being among the most impactful. The risk of nationalization can lead to significant financial losses and disrupt long-term planning and operations. Comprehensive risk assessment. Country risk analysis. Before investing, companies analyze the political and economic stability of the country. They evaluate past instances of nationalization, shifts in regulatory frameworks, and the general political sentiment towards foreign investors. Scenario planning. Companies forecast different potential future scenarios, including the worst-case scenario of nationalization. This allows them to have pre-planned strategies to cope with various outcomes. Investment structuring. Bilateral investment treaties, BITs. Companies can leverage BITs between their home country and the host nation. These treaties offer protection against expropriation without compensation and ensure fair treatment. Stabilization clauses. These clauses, inserted into contracts, aim to insulate the investor from adverse changes in laws, regulations, or policies for a specified period. Engaging with local communities. Corporate social responsibility, CSR. By actively investing in local community projects, infrastructure, education, and health, companies can build goodwill. A positive relationship with local communities can sometimes act as a buffer against nationalistic sentiments. Local employment and training. Hiring and training local workers not only boosts the local economy but also ties the company's success to the well-being of the community, making nationalization less appealing. Diversification. Geographical diversification. By spreading operations across multiple countries, mining companies can reduce the impact of nationalization in any single jurisdiction on their overall portfolio. Diversifying investments. Investing in various minerals or metals can also offer some protection. If one mineral is prone to nationalization due to its strategic significance, others might not face the same risk. Active government engagement. Regular dialogue. Maintaining an open dialogue with the host government can help address concerns before they escalate. Transparency. By being transparent about operations, finances, and profits, companies can combat any misconceptions or misinformation that might fuel nationalistic sentiments. Insurance and financing mechanisms. Political risk insurance. Organizations like the Multilateral Investment Guarantee Agency, MIGA, provide political risk insurance, which can cover expropriation. Financing structures. Some companies structure their financing in ways that make nationalization less appealing. For instance, if significant portions of a project are financed by international banks, nationalization could lead to credit defaults. Exit strategies. Quick liquidation. In case nationalization seems imminent, having a strategy to quickly liquidate assets can minimize losses. Negotiated exit. Sometimes, a negotiated exit, where the company receives compensation or retains some stake or operational control, can be more beneficial than a forced expropriation. International arbitration. Investor-State Dispute Settlement, ISDS. Many international investment agreements provide for ISDS mechanisms, which allow investors to take states to international arbitration over unfair treatment or uncompensated expropriation. Mining companies can assess the likelihood of nationalization in a particular country by considering various factors that may contribute to resource nationalism. Here are some factors that mining companies can consider. Political stability. Mining companies can assess the political stability of a country to determine the likelihood of resource nationalism. Countries with unstable political environments may be more prone to nationalization. Historical analysis. Past incidents. A look at the past provides insights into the future. If a country has a history of nationalizing foreign assets, it's often considered a red flag. Post-nationalization outcomes. It's equally important to see what happened after nationalization. Were foreign companies fairly compensated? Was there international litigation? Resource concentration. Mining companies can assess the concentration of natural resources in a particular country. Countries with high concentrations of valuable resources may be more prone to resource nationalism. Political climate analysis. Change in government. A change in leadership, especially to a more nationalistic or leftist government, might increase the risk of nationalization. Nationalistic sentiments. Are there strong nationalistic sentiments within the political class or the general populace? Such sentiments can drive nationalization policies. Regulatory and legal environment. Frequent regulatory changes. If a country frequently changes its mining codes or regulations, it might suggest an unpredictable regulatory environment, which could be a precursor to nationalization. Contract stability. A history of upholding or reneging on contracts with foreign entities can provide insights into the likelihood of nationalization. Economic conditions. Mining companies can assess the economic conditions of a country to determine the likelihood of resource nationalism. Countries with weak economies may be more prone to nationalization as a means of generating revenue. Local community relations. Public perception of mining companies. If mining companies are perceived negatively, perhaps due to environmental degradation or perceived economic inequity, it might increase the public's support for nationalization. Geopolitical analysis. Relations with home country. A strained relationship between the host country and the mining company's home country can be a risk factor. International diplomacy. If a country is isolating itself on the global stage or aligning with nations known for nationalization, it might suggest an increased risk. Analyzing parallel industries. Other sectors. If a country has recently nationalized assets in another industry, e.g., oil and gas, it could indicate a broader trend that might extend to mining. Local media and public discourse analysis. Media sentiment. Analyzing local news and media can provide insights into public opinion and potential government actions. Prominent voices. Statements or opinions by influential figures, scholars, or opinion makers on the subject can hint at future policy directions. Consultation with experts. Local economists, political scientists, and industry insiders can offer invaluable insights based on their on-ground experience and understanding. Intelligence and advisory reports. Think tanks and consultancies. Many global think tanks and consultancies provide detailed country risk profiles that evaluate the likelihood of various risks, including nationalization. CSR initiatives. Conversely, mining companies that invest heavily in corporate social responsibility, CSR, initiatives and have a good relationship with local communities might face a reduced risk. Mining companies can assess a country's history of nationalization to determine the likelihood of future nationalization. Mining companies can assess the regulatory environment of a country to determine its likelihood. Countries with strict regulations governing foreign-owned resource projects may be more prone to nationalization. Engagement with host governments. Mining companies can assess their engagement with host governments to determine the likelihood of resource nationalism. Companies with strong relationships and established trust with host governments may be less prone to nationalization. Mining companies must consider these factors when assessing the likelihood of nationalization in a particular country. By doing so, they can make informed decisions about where to invest and how to mitigate the risks associated with resource nationalism. While the risk of nationalization can't be entirely eliminated, these strategies help mining companies navigate, mitigate, and sometimes even leverage the challenges posed by such geopolitical events. Thanks for watching. Skilling's Mining Review. Resource nationalism is a growing trend in the mining and metals industry, where governments are increasingly asserting control over natural resources within their borders. This trend is driven by a variety of factors, including economic recovery, energy transition, and political instability. The rise of resource nationalism is a concern for mining companies, as it can lead to increased taxes, royalties, and other costs, as well as greater regulatory and political risk. It can also lead to reduced investment and production, which can have negative impacts on local communities and economies. A 2021 report by global risk intelligence company Maplecroft identified an increasing risk of resource nationalism in as many as 34 countries around the world. The top 10 in Verisk Maplecroft's Resource Nationalism Index comprised Venezuela, the Democratic Republic of Congo, Russia, Zambia, Zimbabwe, Kazakhstan, North Korea, Tanzania, Bolivia, and Papua New Guinea. The mining and metals industry may be facing a renewed period of intense resource nationalism. Resource nationalism in the countries that produce rare metals and minerals may slow the adoption and spread of low-carbon technologies. While resource nationalism had been relatively contained geographically speaking in the past, it is spreading across the world. Resource nationalism is a trend where governments assert control over natural resources within their borders. This trend can have significant impacts on the mining industry, including increased taxes, royalties, and other costs, which can reduce profits for mining companies. Greater regulatory and political risk, which can make it more difficult for mining companies to operate in certain countries. Reduced investment and production, which can have negative impacts on local communities and economies. In sub-Saharan Africa, SSA, countries where resource nationalism risks are high and/or rising include the Democratic Republic of the Congo, DRC, Ghana, Guinea, Mali, Namibia, and Zimbabwe. Increased government intervention in the mining sector of these countries will generally aim to extract greater value from the mineral supply chain for local stakeholders including the government, taxes, employees, jobs, and the mining service industry, suppliers and contractors. Resource nationalism represents a major challenge to investors in resource-rich economies and one that appears to be growing. With some commodity prices at an all-time high, governments are increasingly seeking to assert greater control over their natural resources.